Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, October 22nd, 2022. It's been another great week of shows with great topics and, of course, great guests. We kicked off the week with a look at auto insurance premiums and the impact of the rise on home auto bundling. Let's take a look.
So we've been measuring auto insurance customer satisfaction for 23 years now at JD Power. It's actually our flagship product in the insurance space. And the big story that we saw this year was price satisfaction started to decline. Starting in about August of last year, we started to see insurers take rate. And as those renewals came up, consumers started to see their prices go up quite considerably. And it's really part of a perfect storm in the auto insurance market right now. We're starting to see frequency and severity come back, when in the past, frequency and severity was really the leading driver of auto insurance premiums going up. But right now, what's also affecting that is the price to repair vehicles, used car prices going up, which obviously impacts not only repair costs, but also those total loss costs. And so right now there's a lot of pressure on auto insurance companies to stay profitable, and they obviously need to pass that, price increase along to consumers. So it goes through the underwriting process, and there's multiple factors that go into, what you're going to pay for your auto insurance premiums. And one of the big trends right now in terms of auto insurance is usage-based insurance or telematics that gives you more of a personalized rate, not just on the characteristics of other people that are like you, but exactly how you drive and how much you drive. And we actually saw that become more popular during the pandemic as, customers saw their vehicle sitting in the garage, not using it. And, perhaps through education of insurers giving back premium due to customers not driving as much, they made that connection to risk versus what they're paying. And we saw these programs jump up in their usage by 33% through the pandemic. And that's actually maintained in this last year as well. During the pandemic, yes, we did see, an increase in severity, even though the frequency was down. And part of that was the roads were empty, people were speeding. Maybe they were using their phone more often. And so while the frequency was down, the severity was up because those accidents were at higher speeds. Now, post-pandemic, we're starting to see that frequency come back. I think the bigger question there in terms of the driver safety is vehicle equipment. Is that actually making us safer on the road? And how does that actually translate to insurance premiums? You would think that, these safety features are going to reduce the frequency of accidents. And that's true. But on the flip side, it's much more costly to repair those vehicles. So that bumper today with, 10 sensors in it and a camera up front, that's going to cost $3,000 when it used to cost $500. So there's sort of a balancing act there for the insurers. Well, there's certainly the common things that everybody thinks of: avoid accidents, avoid tickets. But, some of the other things that customers maybe don't think about as often is don't forget to shop. It's not a bad thing to shop and make sure that you're getting a rate that you think is of value for the service that you're going to get for that premium that you're going to pay. And another good area is make sure you're reaching the discounts that are available to you. Some drivers don't think about, especially if they have a family, you can get good student discounts for your teen drivers. If you reach retirement age, you can get retirement discounts. And what I think we're going to be talking about a little bit later, don't forget to explore what discounts you're going to get for bundling multiple policies, whether that be home and auto or multiple vehicles. There's other small segments where, you might be able to find a better rate for, say, a classic car with, somebody that specializes in that.
Next up, we explored how students used over $30 billion of COVID financial aid. Let's take a look.
The beginning of the COVID pandemic especially, but certainly the whole time, was a time of tremendous disruption on campuses across the US. College students really colleges and students had to really pivot a lot, had to leave campuses, had to transition to distance learning, had to have an experience that they really hadn't signed up for on all parts. And so early in the COVID pandemic, Congress recognized the need for funding to help our nation deal with the impacts of coronavirus. They passed the CARES Act, which, among many things, included funding for colleges and universities and their students to help them deal with all of these disruptions that were caused by the pandemic. And so over 3 rounds of funding, CARES Act was the first one, and then there were 2 subsequent rounds, one later in 2020, and then another one early in 2021, and totaled $75 billion to institutions of higher education. Students spent their money on precisely the things you said. The most common uses were food, books, and housing. Other uses, though, really were just across the gamut of every type of expense you might have as a college student. Transportation, getting to and from either school if you were still having in-person classes, or just getting around generally, buying new computers or getting tablets or some kind of technology that could help you to enroll in distance learning. Internet access, of course, maybe either getting it if you didn't have it or upgrading it if you needed to be able to stream video and do other things that require kind of a robust connection. Students paid their tuition with this money. They paid their medical bills. Pretty much you name it, students use this money for. So initially, Congress limited the use of funds pretty strictly to COVID-related expenses. And so there were students who had things like a car breakdown, that it was an emergency, they had an expense, they wouldn't maybe necessarily be able to keep going to school or being able to go to their job or whatever it might be without that money, but they couldn't use COVID grants to pay for it because it wasn't directly related to the pandemic. So in the subsequent 2 rounds of funding, Congress actually really opened up the use of funds much more broadly. And what we found in our work was that institutions said they were better able to meet their students' needs once that use of funds was opened up. They said any expense that was in a student's what's called their cost of attendance, which is basically just a list of all the expenses that are associated with attending post-secondary education, those COVID grant funds could be used for any of that. So that really helped more students to be able to access these funds. They all had emergencies, but early on when they weren't COVID-related emergencies, they weren't able to get them. Another group that early on wasn't able to receive these grants was students who didn't meet the eligibility requirements for federal student aid. So programs like the Pell Grant or direct loan programs that you've heard of, traditional financial aid programs that are funded by the federal government, there are eligibility requirements to qualify for those. And one of them is that you have to be a US citizen. And so early on, there was an interpretation by the Department of Education that students who didn't qualify for traditional federal student aid couldn't receive these HERF grants, these higher education emergency relief grants. And later on, during the subsequent rounds of funding, the Department of Education changed their interpretation and actually allowed these students to get these funds. So early on, they weren't getting them, but later they were able to.
Well, we're halfway through our best segments for the week. We come back, we take a look at the other half. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Next up, we discussed employee and employer preferences when it comes to retirement income. Let's take a look.
Well, that's a great question, Jeff. So, excuse me. So we've been doing research since 2007 around financial language and around investor behavior. And in this particular survey, this particular study, we looked at 1,000 participants of large plans, and we also conducted 12 focus groups. And I'll say that the focus groups here were more critical than ever before because the surveys just really didn't capture the mindset of employees. And I think some of that is, what we've been through. And we always do see some effects of the markets. We saw it in our research after the global financial crisis, and yet some things stay the same. But one thing that we saw that changed was, I think, is just the pandemic got people thinking more about retirement, more about the end game, more about their life at home with their families and what comes next and where do I go from here. So I think we noticed a shift in mindset a little bit. Yes, I think employers are more in tune with employees' attitudes about these issues than they have been before. And I think part of that is because of data. There's much better data available now for employers to look at. And I think there's been some great things that the industry has learned and has come to grips with about participants and the challenges they face. I do think that thinking about participants in retirement is a little bit of a mind shift. And I think in a moment we'll probably talk about, some of the things we saw there, but there has been a shift. And so there's more for employers to think about. But one of the disconnects, if you will, that we saw was when it comes to turning a DC plan balance into retirement income, 80% of employers said that they had communicated with employees on how to go about this. But yet, on the participant side, only 38% of participants say that they remember receiving information like this. So, and I think part of that is just the challenge of education. I think it takes a long time for messages to get through. One of my clients likes to say that it's a marathon, not a sprint. Communications have to be layered over time for them to really sink in. I think that, gone are the days where we think that a target date fund is a solution for everything. I mean, target dates are still great. They've amazingly, transformed the industry and done so much for participants, but they're not the answer to every challenge. And I think I think the mindset's become more healthy here. I think it used to be almost heresy to, suggest that we can do better than just target dates alone. And I think now there's a lot more creative thinking going on, ideas like defaulting older participants into a managed account program, and with an opt-out, of course, to try to better prescribe a retirement solution for those participants. Older participants have more complicated financial situations. They have more to deal with. And so it makes sense that maybe the one size fits all doesn't work for everyone, especially when they're getting close to retirement. Yeah, so there are some generational differences, but I think what was most striking is overall, 83% of participants said that their DC plan was going to be their number one source of income in retirement. And that was far above Social Security at 63% or defined benefit plans lower than that. Even more interestingly is if you look at just the participants that are covered by a defined benefit plan, still 79% of those folks said that the DC plan was still going to be their number one source of retirement savings. And I would say that the biggest difference generationally was as you get younger, the more expected dependence there is on the DC plan and the less so on defined benefit, which you would expect. But the attitudes around, maybe surprisingly, the attitudes around Social Security were pretty constant. So not a whole lot of difference among generations and how important that was in the overall scheme of things. Yeah, so this is where we've seen a huge shift. In fact, those of us in this industry know how glacial, some of these movements are. But we've seen a big shift in the last 5 to 7 years on plan sponsors and their desire to retain participant assets. So as part of our study, we surveyed 100 large plan sponsors, and 77% said that they were either actively encouraging or simply wanting participants to retain assets in the plan. A much smaller percentage were neutral, and only 1% said that they wanted participants to leave the plan. And interestingly, 50% of plan sponsors said they were actively encouraging participants to stay in the plan after retirement. So, and that's a pretty remarkable shift from what we've seen in other studies over the years on this. Yeah, I think a more holistic view is more common now, and I think that's due to a couple of things. In our study, plan sponsors said their number one reason for wanting to offer retirement income was to take care of employees. And I believe that. I think that there's, and it's not all, based on altruism either. There's studies and data out there showing that when participants feel better and more confident about their finances, they're likely to be less distracted and better employees. And, financial, and on the flip side, financial trouble has been noted as one of the biggest distractions for people, doing their jobs. So I think that employers are aware of this, and they're looking at financial wellness, just like they're looking at, physical wellness and healthcare, and thinking about what they can do for employees. And given employers, bargaining power and their size, typically in all of these areas, they can get better benefits than people can find in better investments and better programs than people can find on their own.
And finally, could the UK pension crisis spill over to the US? Let's take a look.
One of the reasons why we wanted to comment was specifically to address the question for state and local plans, which, roughly have close to $1 trillion in liabilities. And our conclusion is essentially, the bottom line is we don't think this is a major risk for plans, for state and local plans in the United States. But that doesn't mean that they are not exposed to investment risk. So at the end of the day, on the question we spoke of earlier, state and local plans in the US use what is called an actuarial discount rate when they're valuing their liabilities. And that has the advantage of being steady. It's linked to the policy choice that the pension plan makes rather than to what the market rates are. And so it's not exposed to that variability. The problem with that is that for most governments in the US, for most plans in the US, that rate is too high. The world has changed over time. The expected real growth of the economy is arguably lower over time. And we've been arguing for more than 10 years that rate is too high. So we adjust, when we do our analysis, we adjust the liabilities upward to reflect what we think are lower likelihood of growth in assets over time. But the stability of that actuarial rate essentially makes liability-driven investment less relevant for U.S. plans. So most of them are more exposed to stock market gyrations and to the opaque investment values that are tied up in real assets like real estate and commodities and other alternatives. So different risks. Part of the methodology that's used by actuaries is essentially to smooth in this volatility over time. That's advantageous from the point of view of governments, because governments obviously they have to budget. They have to think about how they're going to allocate resources over time, and stability in allocations is always most important, particularly around something like payroll and benefits, pensions. Well, I guess I would say I'm not an expert on pensions globally, but as a practical matter, if there is an additional trigger to volatility that weakens markets, it's going to affect neighboring markets. That's the part of the fundamental of having, a sort of globalized economy, is that when one person catches a cold, all of their neighbors are going to catch a cold as well. But the method by which they catch it in some ways may be distinct. So if the situation in Britain was having a broader effect on global confidence and on markets for debt, that could have had an impact on the U.S. markets for debt as well. It's difficult to say, and I'm speculating, but as a practical matter, then that could affect the performance of investment pools here over time as well. So it is important to recognize that in an interconnected world, all of this is meaningful to us as well as our neighbors. My colleagues in the sovereign group, my colleagues in the corporate group that follow the corporate sponsors of these plans are going to be watching very closely what it means for Britain. On our side, we're going to continue to focus on the performance of pension assets, public pension assets, and how this volatility translates into higher costs for government. It is something that is particularly meaningful, as Fitch, as well as many others, are forecasting a mild recession in the U.S. next year. And we're as an analyst, I'm curious to see how does that play out in pension funded ratios and in the demand for contributions from taxpayers.
That wraps up this episode of BRN Weekly. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, entertainment, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, we'll visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN Sunday. I'll be joined by members of the media, academia, financial services, and government as we break down all the news and events for the week. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.